Hi, everyone. Welcome to Streaming Media Connect. This is the opening session. My name is Evan Shapiro, and I'll be doing your keynote here. Just a little housekeeping before we move on. The first person who correctly names the music that was just playing, which even I knew, by the way, and is here at the end of the session. So there's two components to winning. Gets a $50 Amazon gift card. So again, it's not enough that you put the correct name of song and band, which is a hint, not a solo artist in this case, in the chat, but you also have to be here at the end. So the first person who does that and is here at the end will win a $50 gift card. We are doing panels and speeches for the next few days. Today, tomorrow, and Wednesday, right here in this environment. Please stick around. And by the way, I'll be taking Q&A at the end of the session. Save your questions for the end. Towards the end, I'll let you know it's coming, and then you can raise your hand, and we can have a nice back and forth on the Q&A. So thank you all for coming. Wow, we have pretty good attendance here. Without further ado, I will get into my session. Let me just get to my first slide really quickly. So, as promised, the name of this session is called No Quarter, a trip through the earnings bombastic. So this is my attempt to share my analysis of all the earnings reports from the third quarter for the major media players. I do not get to everybody because that would take too long. However, we're going to go through most of the major players in video, in tech, slash social media, and in a bit in gaming and audio as well. And what I found is the reason why I wanted to do this, and I do this actually every quarter, both on my newsletter and in a webinar for subscribers there, is because I found that very few of the analysts who are supposed to be covering the media industry and very few of the trade writers who are supposed to be covering our media industry actually take the time to go through the earnings reports themselves versus just listening to the earnings calls, accepting the spin of the C-suites from the companies who are reporting their results, and then just regurgitating them as headlines the next day. And oftentimes what happens is you'll see a major stock bump or drop because of something somebody said or in the earnings call or an interpretation that one analyst will have. And then a couple of days later, things will kind of trickle out that are the reality of the situation, and the trends reverse themselves. So rather than allowing you to be misled by any of the spin from the C-suites, I'm going to take you through what my interpretation of the earnings call, the earnings reports, the actual data from the reports themselves are. And I have to let everybody know that if you want to track these companies responsibly, go into their earnings reports, the PDFs on their websites. They publish them right during the calls themselves. These are not dense documents. They're not difficult to read. They take about 10 to 15 minutes to really get the information you need each quarter. So without further ado, let's start going through them. First of all, it's important to get the larger context of the world. This is the map I do on a regular basis. I have not updated it since earnings season started to tail off. But it's also important to look at the major trends in the ecosystem from a revenue standpoint and from an audience standpoint as well. So,
Hey, Evan,
yeah,
can you go into slideshow mode?
I am in slideshow mode.
Um,
Okay, I will stop and start over again. Sorry about that. Can you see now?
Perfect. Yeah.
Okay, sorry. So it's important to look at the larger context of where all these companies are relative to each other from their resources and their market capitalizations and their valuations. But it's also important to look at the larger context of where the revenues in this ecosystem are actually going, not where they are today, but where they're headed, where their revenues are growing and where they are not. I use these two slides to set that table, but without further ado, let's start digging into the specific players themselves. And you'll note that on each one of these slides, I show different elements for different companies that I think are the most important ones to track. And I'll show you the share price from the last 5 days, not necessarily since they announced their earnings, but for an apples to apples comparison in the last 5 days. And so when you look at Amazon, across the board, these were great results. Their advertising business, the fastest growing advertising business in the world, grew by 26% in third quarter. And you have to remember that, first of all, this is primarily, if not almost exclusively, retail media at this point. So this is ads sold to consumer goods companies advertising their products one click away from a purchase on Amazon. You can see that their e-commerce is actually growing much better than it did last year, which is one of the major reasons that their operating income popped so heavily. They had a really bad 2022. Especially in commerce, where they overinvested and actually lost a tremendous amount of money in the first half of 2022. So, part of the pop in operating incomes comes from just the pure year-on-year comparison. But still, it's a massive uptick in revenue. And it's important to understand that from an advertising standpoint, this is where a tremendous amount of their profit is coming from right now. They did $12 billion in advertising revenue in third quarter alone. Think about that for a second. And they have just barely started scratching the surface of their mainstream media ad sales business, their video ad sales business, their audio ad sales business, their gaming ad sales business. Their total revenue went up 13%, which is pretty healthy for a company that's this mature, and does so many different things. And yet, when you look at the trade and the trades and the analysis after their earnings report, Amazon stock actually dipped that day because their cloud business wasn't growing fast enough. Their cloud business only grew by 14% year on year. And remember, Amazon AWS, this is a pretty mature business compared to the rest of the entire ecosystem. And so, yes, the growth on cloud has slowed for them, but it still grew in double digits, healthy double digits. And I think there's a larger trend at play here, which is this, I think, bubble that's growing around the AI conversation. Not to say that Gen AI and AI are not going to be important, but there are companies basing, debt raises on buying NVIDIA chips as a futures bet right now. One of the major reasons Amazon stock dipped is because analysts were not pleased that their AI cloud-based computing was not growing fast enough. And when you look at the rest of these financials, in my mind, that just doesn't make a whole lot of sense. This company is diversified in a way that very few other companies, even in big tech, and we'll talk about Apple in a second, are. And they're incredibly poised to grow their ad business, their media business, their services business, and a bunch of other things. And with their e-commerce bouncing back in 2022, this is a company that I think is going to, from 2022, I think this is a company that's going to have a pretty healthy, if not massively successful 2024. So when you look at Apple, by comparison, by the way, yes, their net income went up, but their product revenue went down by 5%. In fact, every piece of hardware that the company sells went down in third quarter from a revenue standpoint, except the iPhone. And the iPhone only went up by 2%. And so for a company that, gets most of its revenues and the vast majority, if not all of its profits from hardware sales, this is not a terrific story. However, their services revenue, so their television, the music, the arcade, the revenues that they generate from taxing in the App Store, and what has become an emerging, still very slow growing ad business went up by 16%. The total revenue for Apple went down by 1%. And, kind of taking this story out a quarter, Tim Cook said that they expect hardware sales to actually be maybe even a little worse year on year comparison wise in fourth quarter. And so what's odd is that Apple stock kind of just went meh the next day, and it's up in the last 6 days, which just shows how massive this company is. And how they're moving very quickly towards revenue diversity. But if you're, looking for an explanation as to why Apple is investing all of its chips, pushing all of its chips towards its services business, this chart says it in big, bold, red letters. Furthermore, I think what you're going to see is a huge move into the ad business starting next year. They hired a head of ad sales for the company, new head of ad sales for the company this year. That's, for their television business. which I think, obviously promises something new, especially around their sports investments that they're making. They're rumored to be, bidding very high on Formula One rights right now. However, I think you're going to see them even maybe double and triple down on that. So the NBA rights come up in the first quarter of next year. Warner Brothers Discovery is very vulnerable around that. I don't think Disney's going to risk losing their NBA rights, but I don't know how Warner Brothers Discovery can afford to keep pace with a big tech Death Star like Apple or Amazon, should they get into the sports rights business. But crucially, Apple's going to build a very strong, very big, best-in-class ad business in their app store. This is going to be one of the big new additions to the service revenue sector for Tim Apple at Apple. And I think that they're going to, the way that they did, 5-6 years ago in audio and in other services, a couple of years ago in gaming, which is actually going quite well for them now. I think you're going to see them lean very hard into that. I also think you're going to see in the next 24 months a very big concentration around their Amazon Prime competitor, Apple One. So far, they're not really focusing it on it all that much, but I think you're going to see that change over the next 24 months. Meta had a massive third quarter. Now, part of this is also year-on-year comparison. So they had a really shitty 2022. They had a really bad first half of 2022. They had an even worse second half of 2022. So net income is up 164%. That's a great story. But again, you have to kind of put that in context. Their total revenue is up 23%. But again, look at the year-on-year comparisons. So they're really just getting back to the growth trajectory they had a couple of years ago. But the story is overwhelmingly good. This is a company that is bouncing back. And both this indication and Amazon's indication and a couple of others speaks to a much larger trend, which is the ad economy itself is bouncing back. Once again, it's a phrase I'll keep repeating until the horse is actually dead, which is a lot of this is year-on-year comparison. Last year, we were mired in the middle of a deep ad recession. So when you look at what was happening last year, ad buying and ad selling was down year-on-year pretty dramatically, especially last summer and into the fall. So the ad economy is coming back, but it's all relative to the whole. The second part of that is the ad economy is coming back, but it is concentrated almost exclusively on digital media and disproportionately on the big three, Meta, Google, and Amazon. It is not being shared. This bounce back, this comeback, this rebound in advertising sales and buying is not being shared by traditional media or even a large part of all of digital media. When you look at Meta. So Meta is getting a very big share of this. Part of this is, Zuckerberg finally realizing that his hyper focus on the metaverse, thus changing the name of the company, was distracting the company from their core purpose, which is selling ads. 98+% of the revenue at all of Meta across all their platforms is advertising. They'll talk about Quest. They'll talk about the metaverse. They'll talk about all these other things. They are a 98% ad sales company. And so they concentrated the first half of this year on a couple of things. One, being better at selling ads and focusing on selling ads, but secondarily, working around the Apple's privacy changes in the App Store and creating algorithms on Instagram that sells you more shit in your Instagram feed that you set in front of your iPhone last night. And so these privacy settings are, I'm not saying they're able to manipulate themselves around them entirely, but their ad products and the algorithms on Meta are improving every quarter on their ability to reach you and sell you stuff that you search for on other parts of the ecosystem. But when you look at Google as well, YouTube revenue up 12%. And again, that may seem kind of moderate for a platform as large as YouTube. But when you look at their year-on-year comparison, last year, they were flat or down pretty much every quarter on YouTube. Their total advertising is up. But again, that's a nice turnaround for them from even just, earlier this year and late last year. So their operating income as a result of that is up 25% and their total revenue is up 11%. In this case, their cloud business grew 22%. And once again, Wall Street wasn't satisfied. It was what I call the Jewish mother's response to a report card. You only grew 22%. Why couldn't you grow 25%? And once again, I feel this is part of a larger AI bubble that's being built right now. Again, AI is not going anywhere. Gen AI is not going anywhere. These are going to be massive businesses, and they're going to be important parts of the media ecosystem. But there's a hyperbole to it that's taken hold that knocks Google for only growing their cloud business, specifically around AI computing, by only 22%. That seems a little irrational to me. But once again, looking at this ad business here and at Meta and at Amazon, this repeats this trend that I've been talking about, which is the ad business is rebounding. It's coming back, but it is really disproportionately benefiting digital media on the whole, and I'll talk about other players as well, but primarily, not exclusively, but primarily the big three, Amazon, Google, and Meta. And here's a slide that demonstrates this. 2023 ad spending, this is based on Magna Global estimates. And this is reflected around the world as well, maybe not as dramatically as 60%, but Google, Amazon, and Meta controls 59% of ad buying or ad spend in the United States. And then when you look at other digital, look at how small the pie slice of other digital is. And this is why BuzzFeed is quickly going out of business. This is why Vox is having such trouble. This is why everybody in digital, other than the big three and TikTok, are having such issues right now. It's important to note that inside other digital, of that 9%, TikTok is about 7%. So think about that. Leaves 2% in other digital for everybody else. That's problematic if you're not one of these three. You can see traditional media still controls about a third of the pie, but that slice is going to get smaller and smaller and smaller and smaller every single year. Well, the big three, and I think you're going to start to see Apple represented in the other, but also eventually in the big four, as I'll begin to call them when they take enough of the pie. That slice of the pie is going to grow larger, which is one of the big reasons when I talk to traditional media companies, whether they're American media conglomerates or public service media or commercial media in Europe or anywhere around the rest of the world, the idea that you're going to grow your ad business, so you're going to grow your revenues, that you're going to grow your platform without working with Meta and Amazon and Google when they take up this much of the ad buying on the planet Earth is folly. You cannot do it. Remember, Meta is sharing their ad revenue with other players. Google is sharing their ad revenue with other players based on video views and other impressions that they generate. And Amazon will get into a similar business as well. When you go further, so as we dig deeper into the more traditional end of the business, where I wholly put Netflix, especially now, when you look at their third quarter earnings report, they've become basically a traditional television outlet in the digital era, but they are a traditional channel now, just like the rest of traditional media is. They're spitting off good net income. But their growth trajectory has become basically a regular television channel business, especially because they basically have one and only one revenue source, which is subscriptions. Right after their earnings report, Netflix put out a blog post from their new head of ad sales, and they were touting 1 year in the advertising business, and they were celebrating a bunch of accomplishments. And one of those accomplishments was they reached 15 million monthly average users for their ad business, for their ad tier. 15 million monthly average users. YouTube has 2.5 billion monthly active users. TikTok has 1.7 billion monthly active users. If you have 15 million monthly active users on your website, you can't get through the lobby of most ad agencies in the media world right now. So yes, Netflix had a really good third quarter. They added 9 million new subscribers, primarily driven by their lockdown of password sharing. They spun off a decent amount of cash flow. They had a good revenue bump. But when you think about their ad business, which another thing that they were touting was that they were about to add 30-second and 60-second ads to their ad product. These are new things for them. So when you think about, this new revenue source for them, and you think about how much of a bump they're getting from this password lockdown that they're going through right now. What happens when that bump of new subscribers from password lockdown ends? Where does the growth come from? They raised their prices this quarter, following a lot of other leads like Disney and others. And that's one way to grow revenues. But when they eventually lose the bump of password sharing lockdown, where do new revenue sources come from? Because right now, I'm looking at their ad product, and it's definitely not coming from there. You look at Comcast, moving further into traditional media, and this is an interesting company to take a look at right now. Most crucially, sorry, I stopped sharing screen. Most crucially, hold on one second, I apologize. This is a diversified revenue company. I think that's one of the things that I think puts them in a good position versus a lot of other traditional media players in the space, to get to the other side of the media apocalypse we're on. They have various different inputs, broadband and mobile phone sales. Their mobile phone signups actually are rising at a good clip. But there's some basic underlying problems about their business. So first, let's look at the good stuff. Their direct-to-consumer revenue is up 64%. That's Peacock, both subscriptions and advertising. But remember, that's starting at a very low base, far further behind the rest of the traditional media's direct-to-consumer businesses versus everyone else. Crucially, look at their core business here. Their MVPD revenue, which is a combination of video and telephony, and broadband, was down, 0.5% year on year in third quarter. They lost broadband subscribers again in third quarter. Broadband has peaked for Comcast, and not just for Comcast. That's true of pretty much all the MVPD ISP businesses. The distribution of broadband in the United States has pretty much plateaued. So it's going to be a massive revenue generator for them, but the growth has slowed, if not plateaued. And at some point, if you're not growing, you're shrinking. Media revenue up, basically 1%. Total advertising down 8%. If it wasn't for the parks revenue, Comcast probably wouldn't have had a net income growth year on year. And their revenue would have probably been negative. So a bounce back at their theme park division, which again speaks to the importance of diversified revenue sources for all companies. Big tech, look at Google and Amazon versus Apple, and in traditional media, parks revenue here. So Comcast, I think, is well positioned. But if you're wondering why they're going all in, putting all their chips on their JV around Xumo with Charter, this chart says it in big, bold, red letters. Broadband is flattening. The media revenue is not growing. Yes, they have a parks division that's generating income from them, but it's not going to come anywhere near, neither will direct to consumer streaming, to replace a flattening or falling revenue sources in these other areas. And by the way, this repeats this theme that I was talking about earlier, which is the ad economy is coming back, but it is not benefiting traditional media as much as it is benefiting digital media. In fact, it's not benefiting traditional media basically at all. We can take this even further here. If you look at Disney's business, their overall, sorry, I'm trying to move my screen. Their overall revenue went up 5%, which is actually really good. Their operating income went up 5%. But their television revenue, which includes both their distribution revenue and their advertising revenue, fell a combined 9%. And their ad business, despite having Hulu, which is a very good digital ad product, is falling at a pretty healthy clip. And Iger seemed to point to a fourth quarter that might even be worse. Now, their direct-to-consumer revenue is up year on year, despite losing subscribers, by the way. And that's largely driven by two things. The average revenue per user on Hulu, which is the highest in the industry, and again, speaks to the health of having a streaming platform that does both subscriptions and advertising really, really well. Nearly 60% of Hulu's subscribers are on an ad tier, and those subscribers are their highest average revenue per user users. Compare that to Netflix's story and look out 18 months and see where that goes. But again, speaking about this theme of revenue diversity, Parks revenue is what saved their quarter. Again, this is not the first time this happened. This happened in first quarter as well. Parks revenue is up 13% year on year. Part of that is attendance. Part of that is raising prices, by the way. And pretty much all their revenue increase and all their operating income increase came from parks. So yes, they had an okay quarter, but it wasn't their media businesses that really did this. One important thing to note that's underneath the numbers here, there's a lot of talk about selling off pieces or all of ESPN. That's definitely not going to happen. And there's a couple of, the big reason for it is TV revenue at their TV division went down 9%, but operating income at ESPN went up 13%. ESPN is slowly transitioning from a traditional television business into a pure digital play, and they're going to migrate that to a bigger direct-to-consumer business. I think, the lion's share of that effort will come next year. So I think it's important to watch what happens here. Also, Disney was able to shrink dramatically their direct-to-consumer losses. And Iger is saying, and the company is saying, that they're going to get to profitability in direct-to-consumer next year. However, that's not going to counteract their losses in television revenues. And so they're going to have to move further and faster there. I also think they're going to have to look for some other ways to generate revenue to counterbalance the losses they're going to experience in television. Paramount, mixed bag here. It kind of interesting. Once again, advertising sales dramatically down, despite the fact that Pluto did almost $500 million in ad sales for them in third quarter, which is a one part, if not a big part of their direct-to-consumer revenue growth at 38%. So they raised prices, they signed up more subscribers. I think 3 million additional subscribers in third quarter. So that's one part of their direct-to-consumer revenue growth. But also their ad sales business on Paramount Plus and very crucially on Pluto really grew very healthily. If you extrapolate the third quarter sales on Pluto to a 4-quarter business, that's almost a $2 billion a year business just on Pluto, which is really impressive. It's also impressive that they were able to, on a revenue increase of 3%, while losing 9% on advertising and 8% on television revenue, they were able to increase operating income 10% to around $650 million on a $7 billion total revenue business. That's pretty impressive. So I think, the advertising story going down 9%, which re-emphasizes that trend of advertising's bounce back is not helping traditional media. But it is really benefiting digital media, and the bifurcation of Pluto and their traditional television business at Paramount epitomizes that. But it also shows that you kind of have to have massive scale if you're going to compete with the digital players out there. But when you look at this overall business, I think the management here being able to get to 10% operating income growth, total revenue of 3% growth while cutting costs across this enterprise, despite falling revenues in advertising and traditional television distribution, speaks very well to the management of this company, as opposed to Disco Brothers. Now, cost cuts here also are why their operating income popped 104% here. So, Zaslav's deep cuts, shelving big films like Coyote versus Acme, which has really upset a lot of consumers. Cutting staff, cutting a ton of content from their platforms. The cuts are really what turned the operating income around. Now, again, this is largely a story of year-on-year comparisons. Last third quarter, I think they lost over $2 billion. This quarter, they made $97 million in operating income. So it's not a massive amount of operating income, but compared to the massive losses of last year, that's a good story. However, when you look at the rest of this, especially when you compare it to a company like Paramount, whose direct-to-consumer business grew by 38%, whose operating income grew by 10%, whose total revenue grew by 3%. Yeah, Warner Brothers' total revenue grew by 2%, and their operating income is up, but it's $97 million on a total revenue base of $10 billion versus $600 million on a total revenue base of $7 billion. Their direct-to-consumer business is up only 5%. This is supposed to be an emerging growth sector for them, and it's up only 5% year on year, which is lower than pretty much everybody in their competitive set. And their advertising numbers are actually dropping faster than anyone in their competitive set. So yes, traditional media is being punished by this ad bounce back, but Warner Brothers seems to be taking a much larger brunt of that ad sales downturn than their traditional media brethren. And I think this is one reason why, and Zaslav pointed towards an even worse fourth quarter. So this is one reason why their stock dropped like a stone, Harry Potter and the dropping stone, the day after their earnings call, but it's also down 13% just in the last 5 days. Oddly, though, despite all of this, and despite $45 billion in debt that they're still paying off, Zaslav and Malone seem to be pointing towards the fact that they're going to start acquiring other companies now, which I don't know how they're funding that with $45 billion in debt. And I don't know what they think they're going to buy either. But they say consolidation is coming and that they're going to be an acquirer. I think consolidation is coming, but I think this company in not too distant future gets acquired. And then there's this one. Yeah, I mean, total advertising down 2%, which is not as dramatic as, say, like Disco Brothers. But total distribution revenue flat, net income down 32%. With Rupert retiring, with an aging audience on Fox News and billions of dollars of court losses already in the can and more on the way. I just don't see this as a company that has long-term standalone prospects. As Logan Roy might say, I don't think these are serious business people. And I don't see how a company entirely wrapped around a traditional broadcast business, which is dying, and a cable news business, which is, still massive, but aging faster than Methuselah. I can't see how this company lasts long term as a standalone business. And this is what I was talking about before. So to bring this trend back and keep beating the dead horse, this is what I mean when you look at this. This is Magna Global just recently revised their projections for 2023 and 2024, and you can see in second quarter actuals, total ad spend went up 4.4%, digital media up 8.7%, traditional media down 4%. Projections revised up by Magna Global for the rest of 2023. So for the full year, up 5%. For the full year, digital media up almost 10%, traditional media down 3.6%. Projections for next year, Magna Global adjusted up 5.6% for total ad spend, almost 10% again for digital media, down 2% for traditional media. So this is a bounce back that is not bouncing back for everybody. However, Roku really seems to be fitting into the digital media story when you talk about the advertising economy. So they saw platform revenue, which is largely driven by ad sales, but also by their share of subscription sales on their platform, go up 18%. Their device revenue, driven by television sales, so their dongle sales are slowing, but now their branded television sales are actually doing quite well, and that's how their device revenue went up 33%, and this combined to drive their total revenue up 20% in the quarter. This is an earnings report that Roku very much needed. They've had some bad earnings reports in the first half of this year. Going back to last year, their market valuation had been plummeting. This spiked their stock and actually lifted the entire media sector the day after they reported. So they're up to, I think, close to between 11 and $12 billion in market cap, where they were down to 8 billion before their earnings report. So this was a great overall story for them. However, their net income dropped 170% year on year. And this is not a year-on-year story. It was negative in third quarter of last year. It was negative in second quarter, and it's even more negative in third quarter of this year. And this is after slashing costs, cutting staff a couple of times this year. And so, and when you look at the trend of their net income, it's not a great pattern. And so, yeah, I think Wall Street, again, I think this is an example where Wall Street didn't read all the details of the earnings report. They embraced the fact that these numbers were really excellent. Revenues across the board up. Their device sales and their platform, both sides of the business doing really, really well. But when you look at this, especially in context of all the cost cutting that they're doing, and the fact that they've generated more revenue for themselves in the quarter, and yet their net revenue is as low as it's been in over a year, that gives me some pause. Spotify also had a really good third quarter. Total revenue up, total monthly average users up, total paying subscribers up, advertising up, all across the board. So their total revenue up 12%. Their operating income went up 114%. They showed a net profit for the first time in almost 2 years. Spotify had a quarter where they had a net profit for the quarter, which kind of boggled my mind because I track them, and it's a rare phrase for them to utter. When you look at their pattern, they really don't make money, and they're not going to make money this year. They made money in third quarter, but they've lost around $250 million so far, or actually close to $300 million so far this year with fourth quarter ahead. And so they'd have to have like a massive fourth quarter earnings for them to be net positive for the year. And you can see this. They don't make money as a business because their operating expenses are so high. Even when they do well, they have to pay more in licensing fees to the artists and to the labels where they rent all of their content, their music. It's not necessarily the tech costs or the overhead, that kind of overhead that costs them money. It's the basic business of distributing the audio that everybody uses on their platform. Also, on a 3.4 billion euro business, $32 million in net profit is a rounding error. Also, to a certain extent, it feels like a bit of cosmetics just so that they could say they had a quarterly profit for the first time in a year and a half so that they could show Wall Street that they did. I'm not saying it was a cosmetic manipulation. I'm just saying it feels like it to me. Trade Desk, really interesting turn of events for Trade Desk. And I'm actually going to add them to the map next revision. And someone worth tracking, one as a bellwether for the overall advertising economy. And so you can see here, again, another big indication that the advertising economy is bouncing back, and especially in digital media where Trade Desk does the lion's share of its business. Total revenue up 25%, net income up 144%. And this is not just a year-on-year story. They had a good, second half of last year as well. And so this is overall a good story. And yet, in their earnings call, this is the one time where reading the earnings call versus the report really matters. Their CEO said that they've seen a lot of softness so far in fourth quarter, specifically in October, on their platform, which is contradictory to what Spotify and Roku and Google and Meta and Amazon all reported. Even Snap and Pinterest are not just saying we had good third quarters, but we see, good stuff ahead for fourth quarter. And Trade Desk said the opposite of that. And they blamed it on the auto workers strike, which had already ended by the time they did their earnings report, and the Hollywood strike, which should have affected them in third quarter equally. So I think there's something else going on here. And I think part of their softness in fourth quarter this year is an aggressive move by competitors into their space as part of the upfront this year. iSpot and VideoAmp and other, ad sales platform partners and ad buying platform partners, I think are frankly beginning to nick away at the share of business that Trade Desk has been controlling. I don't have data to prove that, but that read the earnings call transcript and try to suss out what he's saying there, because it doesn't make a whole lot of sense given these numbers. but something just to keep track of. Okay, moving out of the ad sales business into kind of the more gaming area of the business, which I'll get into a bit more in a second. Microsoft had, again, for the big tech, the continued trends in most of big tech, other than Apple, a really great third quarter. Their productivity business, which had actually slowed pretty badly for them, was up 13%. So that's a really good story for them. Their cloud business was up 24%, and the street actually celebrated the fact that that was happening. Their total revenue was up 13%, and their operating income was up 25%. Conversely, some areas of maybe just warnings to look at. Their gaming and other sector grew only by 2%. Now, I think part of that is the fact that they're due for a new Xbox. I think part of that is they're in the middle of a major reorganization with the ingest of Activision, who they just finally finished acquiring. So just something to look at here, because this is one of the 3 most important gaming companies on the face of the earth. And also LinkedIn ad sales growth is slowing dramatically. They laid off a bunch of people at LinkedIn in the last quarter. And for that business, which had been growing at a double-digit clip for a number of quarters in a row, to only grow by 8%, while the rest of digital media ad selling is growing at double digits or better, this feels like a warning symbol for their ad business. But that said, there's just a lot to like about this business, and most notably, going back to a theme that I've been hammering all session, a diversified revenue model that gives them the ability to celebrate one area and rely on one area of upticks, productivity and cloud in this case, when others may stumble on a quarterly basis, LinkedIn and other. But continuing the gaming story and diversified revenue sources, Sony is just a fascinating company to track. One of my favorite companies to track on my big media universe map, because their valuation basically never changes. And this chart kind of speaks to why. They had a really great quarter in film and television sales. This is one of the big media companies that decided to be an arms dealer versus a platform player. They have Crunchyroll, which is a great platform, but predominantly their entertainment business is an arms dealership business as opposed to a platform running business. They had a great quarter in gaming. PlayStation remains a massive and one of, if not the most popular console out there. Their music division, in a quarter where a lot of music businesses had really tough quarters, did really, really well. And that helped drive up total revenue by 8%. But, for those of us who are old enough to remember the Trinitron and the Walkman, their electronics division continues to disappoint. And it feels a bit like an anchor around this enterprise's valuation. Yes, they have a pretty good chip business and they have a pretty good kind of B2B electronics business, but their consumer electronic business, is basically an inspiration spiral, whereas their services business, is kind of best in class, which is weird because in gaming, their device is one of the most celebrated consumer electronic entertainment devices in the world. Meanwhile, the rest of their electronics really are, again, not just not celebrated by consumers, but not doing well from a revenue standpoint. And that dragged down their operating income as well. And this is why I think their stock it never really drops below a certain level, $100 billion pretty much consistently. And it never really goes above a certain level, 112, $115 billion. So it just operates in this gray area of valuation kind of consistently, almost since I started charting them on the map. It's got a floor, but it's also got a ceiling. Going deeper into gaming, Nintendo had a massive quarter, kind of unexpectedly. They put out their last new version of the Switch a while ago. And there's a great consensus that sales of the Switch and their gaming and their games, their software, had plateaued. And then Super Mario Brothers came out, and it was the greatest commercial for their products ever. Not only did the movie do billion plus in revenue, which benefited them directly in large part, but it also sparked sales of their games and the Switch dramatically, to the point where they had record sales this far out for a console that's that old. and inspiring them to announce on their earnings call that they're going to now do a new film franchise around Legend of Zelda. So Nintendo, my issue with Nintendo is the lack of diversification here. Yes, they sell consoles. Yes, they sold games, and they're one of the three most important gaming companies in the world. However, that's all they do. And I think they're going to really need to investigate other revenue sources, most notably advertising, which is a massively growing sector of the gaming economy that they basically take no part in, and IP extensions and other things like that. But specifically, I think this company needs to really start to investigate the ad business in gaming, and specifically in mobile gaming, if they want to continue to have, quarters like this. Roblox going deeper into gaming, 38% total revenue increase, which is a really good story. They have had a rough year and a half, leading up to the second half of this year. Total revenue up, net income up 0, but that's actually relative to them a good story. Because their expenses had been just climbing and climbing and climbing and climbing. And in the last quarter, they made major cuts, and they were able to cut their expenses dramatically, while not having a detrimental effect on their overall revenue. So this is actually a good story for them, which is why their stock really popped the day after they reported, and their stock continues to climb, up 8% in just the last 5 days. Also, if you read their earnings report, their earnings transcript, call transcript, and you read the reporting that came out since, they mentioned the word advertising 11 times during their earnings call, 11 times. So it's a very small segment of their overall revenue right now, but you can see that they understand that they need to diversify their revenue sources dramatically if they're going to continue growing, quarter after quarter for the next couple of years. However, at between 20 and $30 billion of valuation, I think Roblox is the greatest potential acquisition on the market. Whether you're Netflix or Apple or Comcast or Disney, all of whom have the resources to buy a company this size, this is a massive opportunity for getting younger audiences, for extending the lifetime value of the audiences that you already have, for exploring new immersive advertising products that are different, very, very different from what you have. To me, this is, this company is ripe for acquisition and worth, to Apple, twice the valuation of the company. To Disney, think about, a Disney universe inside Roblox that can double map everything that they're doing, not just from a kids and theme park standpoint, but also from a sports product standpoint and from all their other properties as well. So this feels like a real opportunity. EA, co-birds, by the way, not a great story here. So full game sales up 3%, total revenue up 3%, net income flat, live services down 1%. And so, live services is in-game sales on live gaming. FIFA, which they can no longer call FIFA because they lost the right to that license. It's now called FCEA something I can't remember. In the 2024 version moving forward, a lot of the revenues that they make come from in-game sales on that platform and other live gaming channels that they have. In fact, 70%, almost 70% of EA's total revenue comes from live services, not full game physical sales, which is why their total revenue went up. But full games creation is a really costly business, which is why their net income is 0. This is another company that feels ripe for acquisition, especially in a sector, gaming, that is going through massive consolidations with Activision being bought by Microsoft. This is a great company. They have great brands, some of the most important brands in all of gaming, iconic sports gaming, but they are very limited, I think, to where their revenues can grow, especially after losing FIFA. I do not think that they're going to see the same reaction year after year on sales of that game. And they have very mature titles like Madden that don't seem to have the same, trajectory that they had in years past. And this gets to a larger story that I was talking about earlier, which is when you look at where the money is going, digital video ads. Look at the growth there, 61%. And this is data from Omdia. But there are other Ampere, and I'll show you that in a second. Other data sources that project similar growth trajectories across the universe here. And in-game ads. It's important to note that mobile gaming is now 50% or greater of all game revenues. That greater than 50% of mobile gamers are women between the ages of 25 and 65. And that greater than 50% of all revenues in mobile gaming comes from ads. And that's why you see 102% growth projected for in-game ads over the next 4 or 5 years. Meanwhile, linear television, yes, AVOD and FAST is growing at 84% clip, but relative to the whole, as standalone businesses, compared to things like YouTube and Facebook and TikTok and Snap and other online video outlets, it's not necessarily materially as important as the rest of the ecosystem. Look at where today we're at $2.5 trillion in total media revenues worldwide, growing to close to 3 trillion by 2027. And this is Ampere analysis data. And look at other online ads compared to even Fast and AVOD at $35 billion, or subscription OTT. Other online ads are over 3x subscription OTT revenues. Other online ads are bigger than subscription OTT and pay TV combined. Look at how big gaming is, by the way. And remember, more than half of that is mobile gaming, and that a decent chunk of that is mobile gaming advertising. Look how big other online video ads is compared to subscription OTT revenues and pay TV revenues. And then you look at theatrical, and you can hear everybody kind of lamenting the death of the theatrical business, although Barbenheimer would speak otherwise. But even at its height, it's not really material to the overall whole. So when you look at these earnings reports and you look at these numbers and these results, it's crucial not to just look at them, look at the year-on-year context of each company individually. It's also crucial to look at the trajectory of where they're getting their revenues and where revenues are going to come from writ large around the ecosystem. So that brings me to my big takeaways. For the third quarter earnings reports, earnings season. Big tech successes in services is going to see them all move more heavily into services on a moving forward basis. That's going to include Apple, who's going to get into an ad business in a very big way. But it also includes companies like Microsoft, who just bought Activision, which is basically a services business. But also because a lot of their revenue, almost 70% of their revenue, also comes from live service gaming. But it also means I would look for Microsoft to get into more services business. I would see them moving into audio, moving into video, and television in particular. I think you're going to see Amazon get deeper into the services business and not be so reliant on their cloud business, because their cloud business, as their latest results showed, is slowing a bit. The ad market is bouncing back. I've said this 1,000 times, but only for digital players and very few of them. And so that is going to get even more true as time goes on, especially over the next 24 months. And I think for those of us who aren't one of those big tech, those big digital three, I think it's crucial to find ways to be a part of the massive haul they're making in ad sales. Gaming had a much better 2023 than it did 2022, and it's going to do even better in 2024. But it's really ripe for even more consolidation, not just within the industry itself. I do think Sony can become a buyer there. They could be a potential acquirer of Roblox, but also they could be a potential acquirer of EA. I mean, if Microsoft was able to get Activision through the Justice Department, Sony would definitely be able to get EA through that same gauntlet. So look for consolidation in this business within the industry and then across the ecosystem itself. Cutting costs across the board has helped all of these businesses improve their bottom lines and operating incomes, most notably in big tech and traditional media. So Amazon cut a bunch of costs, Microsoft cut a bunch of costs, Google cut a bunch of costs, and Meta cut a bunch of costs. And so did Paramount, and so did Disco Brothers, and so did Disney. And in fact, Disney kind of reiterated that they're going to make even more cuts on a moving for $2 billion in more cuts, between now and this time next year. But without revenue growth, it's not going to matter. You can't keep cutting yourself to ultimate profitability, especially as a big part of what makes you profitable is dying very quickly, traditional television. So, if you don't have top line revenue growth, and it's really hard to keep top line revenue growth while you're cutting and cutting and cutting down to the bone, it's not going to matter. Television and film is even more ripe for consolidation than gaming. I think, the traditional media players, which include Paramount and Disco Brothers and even Disney and Fox, are very ripe for acquisition. They're vulnerable. Their vulnerabilities are very public. Their stock prices have been suffering as a consequence of that. And so there's an opportunity for an opportunistic cash rich company. Microsoft has $150 billion in cash on hand. That's after acquiring Activision for $70 billion. So, are they going to buy Paramount? I don't know. But could they buy Roku? Absolutely. With the change that's in the executive room, executive suite couch cushions. So television and film is very ripe for consolidation, even more so than gaming, because the players there are just more vulnerable. Losing money year after year is very 2008 and not in a cool, stonewashed jeans retro sort of way. Although stonewashed jeans are not from the aughts, they're from the 90s. Anyway, I don't think Wall Street's going to continue to have patience for it. And I think especially as you're cutting costs and slashing staff, continuing to lose money on a quarter by quarter basis, that runway is coming to an end. And, unless Spotify really has a massive fourth quarter and continues to be profitable quarter after quarter next year, I think Roku, same thing. And I think a bunch of these other companies who are losing money, same thing. I think they're, it's going to be a hard 2024. And it remains very clear that when you look at what happens to a stock the day after a company announces their results, and when you read the headlines, which all sound remarkably the same, which is cut and paste from the earnings transcripts or the company's earnings press releases, that the trade writers and the trade analysts in media really do not spend as much time, energy, or effort reading their earnings reports as they should, considering it's their friggin' job. So those are my big takeaways for the quarter. We do have a couple minutes left. That was almost exactly an hour. I'm happy to take questions. I think Steve is going to moderate the Q&A here. I think there are some Q&As.
Yeah. So we are going to try to do this thing where we are. You get some applause there.
Oh, thank you.
For sure. So yeah, and this was fascinating. My head's spinning a little bit, but
Well, I'll zip through. Why don't I zip through some of these questions that are in the Q&A here?
Yeah, and then we're going to try to do this thing where you just everybody just raise your hand when you have a question, and we'll turn on your mic, and you can be heard.
Great. So you're going to handle that. Eric Hertz asked, what % of Amazon's revenues for Thursday night? I would say between 0 and 1%. In what ways does Apple One resemble Prime? If you look at how they bundle cloud, music, arcade, news, and a bunch of other services, it's a suite. It's a lifestyle bundle. And what's going to happen, I think, especially next year, is that Apple One subscription is going to come free with every device you buy for a year. And so then it's going to look a lot like Amazon Prime in that you get free shipping with your Amazon Prime. Apple won with 1 billion subs. Yeah, that's their number, not report, no way to verify that. What percent is music versus TV or other? So last I could find data around that, music is around between 80 and 90 million subscribers, paying subscribers, which is less than half of what Spotify has. And I think their television product has, I would say let's call it between 45 and 55 million subscribers, but there's no way to verify that. They're very untransparent about it. What will 2023 US ad spend? I don't know that number off the top of my head. Sorry. How much is Fast in this? Fast will be about $4 billion this year. So that really falls into AVOD and Fast, not necessarily digital media. So it really fits into TV, oddly. CTV sits into TV. If big tech is taking all the bounce back money, what is driving TDD growth? Well, big tech. I mean, so a lot of the money that they take in and spend goes to Google and Facebook and Amazon. So, and they even said, if you look at their third quarter earnings, retail media, which is Amazon and Walmart, a bunch of other places, was a big driver of it. Fox positioning is interesting. When does the inevitable consolidation happen? Which network is likely to pick Fox? I don't think anybody picks network picks Fox. You could see a big tech company buying Fox. Although I don't really know how much value is there. I mean, Tubi is a great part of their business, but really only times that Tubi was mentioned in their earnings call was when they said, well, the upside there was not enough to offset the losses everywhere else. Does Sony device business include their broadcast professional products? Yes, it does. The only thing that doesn't include is PlayStation. SEC restrictions on multiple stations in the same DMA ownership will block some consolidation. Absolutely, but not by big tech. What do you think will happen with Fox? I think watch Succession. That's what's going to happen. In the window to build an OTT dead? No, I don't think the window to build an OTT is dead, but you have to have a real special product. Especially, I think you can I will do a panel on this later this week. I think there's a real need for good niche. Crunchyroll is a great example. Real good niche OTT products. What components are other online ads? Great question. It's a lot of social media in there. In fact, I would argue it's almost all social media in there. Do you think it's a good strategy for Netflix to buy Paramount? Yeah, I think Netflix, that would be a great purchase. I think the IP alone, Mission Impossible and Star Trek, definitely worth it. I think I made a good case, or what I think is a good case on LinkedIn last month or earlier this month for Apple to buy Paramount. I think they're the natural buyer of Paramount for many different reasons. Most notably, I think they're the only one that kind of deal with the ramifications of the FCC on the other. What does linear program look like after the cuts? Yeah, it's a good question. Everybody's making programming cuts. So yeah, I don't have high hopes for a great programming year ahead, to be blunt. Yeah, so those are all the questions in the Q&A. Happy to take questions from live chatters or live mics. You're on mute, Steve.
Yeah, if everybody just wants to raise your hand, you can be heard. Let's not always see the same hand.
Nobody wants to raise their hand. Nobody wants to be famous. By the way, just if you're interested, all the slides and a lot of the analysis, don't know why that happened. All the slides and a lot of the analysis that I did, plus a downloadable PDF of the entire deck, are on my newsletter, Media War and Peace. And so if you go there, you can download it from there. Oh, there's one hand up.
And
Glenn Moss. I can always rely on Glenn.
Okay, Glenn Moss, you're on the air.
You have to unmute, I think, Glenn.
You have to unmute, yeah.
Unmute. I think you can hear. Can you hear me now?
Yes.
Okay. In the way that John Malone continues to talk about streaming bundles as some inevitable and could well be future, and the way that he dominates Disco Brothers and such. On a broader question, do you see, though, a company like Disco Brothers and perhaps Paramount and even Comcast seeing their future really as becoming aggregators of as many streaming bundles and platforms as possible, and leaving the rest of what they're doing now behind in the best way they can as their best future?
I think it's a kind of future that might save them. I think being bundled into other services is what can help them protect their ecosystems. But no, I don't think any of those three have an opportunity to become super aggregators. So there's this misperception that the cable bundle disintegrating is what created the apocalypse that's going on now. And that's not entirely true. What happened was there was this thing called the triple play that really protected the video bundle. The video bundle, as you know, Glenn, has really not been profitable for quite some time, really any time this century, right? It's been a loss leader, but it was a great marketing hook for a very profitable triple play, which also had telephony and broadband in it, which is where all of the profit came from. And so the disintegration of the triple play as landlines became antiquities, and the video bundle became excessively too expensive and really not something anybody wanted, that disintegration got rid of the protective shell around the video bundle. And that protective shell was what enabled MVPDs to pay outrageous license increases to ESPN and CNN and all the other Hollywood providers of channels for the up until the mid-teens of this century. But that's so that disintegration of the lifestyle bundle we used to call the triple play is what has caused the media apocalypse. That specifically, not the cable bundle disintegrating, but the protective shell around it. That triple play has been replaced. It's called Amazon Prime. That is the new lifestyle bundle. That has replaced the triple play. But instead of broadband and telephony, you now get home, free shipping and video and audio and all these other services. And so the super aggregator model isn't just aggregating a bunch of channels. It's aggregating audio, video, social. Amazon has Twitch, and a bunch of other services in a hierarchy of fees that the consumer wants. That's the new triple play. And it was already created years ago by Amazon. That's why Apple's going to lean into it. That's why Google is building a similar suite of products around YouTube, YouTube Premium, YouTube Kids, YouTube TV, Google TV. That's why Microsoft is going to build a similar suite of services around Game Pass and LinkedIn and Office 360 and all these other services. So, I don't think Paramount or even Disney, certainly not Fox, and certainly not Disco Brothers, I don't think they have the capability or the muscles to learn how to do that fast enough to compete. Comcast, I think, does, because they've already done it. They invented it to a certain extent. Them and Charter and a bunch of others, they invented the idea of this lifestyle bundle. And crucially, they control almost 70 million broadband homes in the United States. And you can try to do business in the United States without going through the combined 70 million homes of Charter and Comcast broadband homes, but you're going to have a hard time doing it. And so that's why when you look at Comcast and you see they're leaning into the Xumo product, I do think Comcast, if they can pivot hard enough, fast enough, they have an opportunity. Of all the traditional media players, I think they're one of the only ones that can make that turn. I don't think even Netflix has the capability of making that turn. I think they're going to run out of runway in the next 36 months. And I don't think they can grow their ad product fast enough to compensate for what inevitably will be a very fast plateau of subscription revenues. And I think you're going to be left with predominantly big tech. But I do think Comcast, of all the American traditional players, they have the capability of making that pivot.
Thanks.
All right, we have a question in the chat from Cameron Thompson. Cameron asks, where does this leave the long tail of website publishers facing CPMs that keep declining in spite of all the macro good news? How do they adapt?
Yeah, they're fucked. I mean, there's no other, it's not a business anymore. And BuzzFeed proves it. And Vox proves it. And we can go down the whole laundry list of, website publishers. Now, the New York Times, on the other hand, has counteracted that. But the New York Times is a great case study. And anybody who listens to me, I talk about this endlessly as the case study of transforming a traditional media, an ink and paper company in 2010. The old gray lady, they completely transformed themselves into a new product, but it is not a CPM based product. In fact, They're less reliant now on advertising than they were in any point in their entire history. They are now a pure digital product with 10 million digital subscribers that slices and dices their subscriptions in a remarkably interesting way. They're also a top gaming company. They're also a top podcast publisher. And they, to me, are a super aggregator of a very interesting suite. Their CEO even calls their products a lifestyle suite of news and information and entertainment products. Now, they haven't lost their mission to inform and educate the world. They just do it in a completely different model. And so companies who can pivot to that, a mixture of ads and subscriptions, a multi-platform, diversified revenue set of inputs, those are the ones who win. But if you're in a purely CPM-based, ad-based model, and you're a digital publisher, goodbye. You will not make it till the end of this decade. Absolutely not. Do any of these companies disclose their cost to ISPs to reach their customers? No, they don't. They kind of hide it. That's a fascinating question, and that's basically the crux of the net neutrality debate that we're about to have again. None of these companies pay for the bandwidth costs that Comcast and Charter. So like, we're about to see that debate. I sit on both sides of the net neutrality debate. It's a tough one. It's a very gray area. And you feel, it's hard to feel for broadband providers, but you feel for them. They're without them, these Netflixes and Amazon Prime and Disney Plus, they don't exist. And yet these companies aren't paying anything for it. But I do think, especially if you look at the Charter Disney deal, which is going to basically change the entire industry, that one deal, that becomes the model. Like, kudos to Charter for like forcing the issue when Disney really didn't want to do it. But it's going to wind up benefiting Disney. It's going to wind up benefiting Charter. It's going to wind up benefiting the entire ecosystem. I think Charter probably negotiate. I don't know. I have no information on this, but I can't imagine Charter didn't bring that up as part of the conversation with Disney, who has Hulu and ESPN, like streaming live sports. Anybody who has YouTube NFL Sunday Ticket knew that a couple of weeks ago, that shit fell apart, man. And so streaming, live sports is actually one of the most difficult things for the ecosystem. And we're going to hit, as more and more sports moves to live streaming, we're going to hit that logjam, that bottleneck hard. And I don't care how good your airbags are, that your head up against that windshield is going to really hurt. So that's a great question there. Is the conclusion that all these companies will become lifestyle companies offering entertainment, banking? I don't know about banking and all these other things, but yeah, I mean, again, I think it's really instructive and important to look at X's toast. They're dead. Look at, and by the way, I don't think Tesla's long for this world either. Cars catching on fire, that dump truck that they're just about to put out. So, but I think it's really important to look at what built the golden era of television. Like, we talk about Mad Men, we talk about Breaking Bad, we talk about all these great programs from the earlier part of this century. Like, that was entirely built by the lifestyle bundle we called the triple play. That's the only place those revenues came from. It wasn't from profits from selling video bundles. It was from the gravy that came on top of that through telephony and broadband. And so, yes, I think we're going to move from that type of super aggregation into a new type of super aggregation. We already have. We're already there. And there's a number of different reasons for that, but most crucially, that's what the user wants. The users didn't churn. At the height of the triple play, users did not churn. Unless you moved to a new city, you did not churn. And now, with Gen Y moving into their own homes and becoming head of households, and Gen Z moving into their own spaces and not signing up for landlines or cable, they are willing to bundle broadband and mobile and streaming services. So that's the Comcast's and Charter's new bundle. But I do think you're going to see these super aggregators. Tencent already does this. Look, to a certain extent, the New York Times, the case study I just used, they're a super aggregator. They have Wordle. They have a great gaming business, mobile gaming business, by the way, predominantly female mobile gaming business. They've got a great food subscription. They've got a great sports business. They've got a great podcast business. So yeah, I do think we're moving into this lifestyle, but I don't think we're moving into a lifestyle bundle. I think we've been there for the last 30 years and we're just moving into a new version of it. Yeah. I mean, again, there's no advertisers left on X. Every day he puts out something even more racist, anti-Semitic, misogynist, and hateful than the next day. I can't see, other than a hobby that's going to burn billions of dollars for him, I don't see it lasting. Doesn't Netflix's Open Connect give them a unique competitive advantage that they would leverage to become the better distribution platform for other media companies' content? They don't seem to have an interest in that. Maybe that happens. Maybe. But again, I just don't see how they compete with Amazon channels or Comcast's business. And, you know, I wouldn't say that Netflix has proven to be a very innovative company. Basically, their business has not changed in about, you know, so they really got into the streaming business in you know, 20, let's call it 2008. They've been really into it, you know, for the last decade, you know, since they started streaming content. Like, what's the major innovation there? Better tiles. Their algorithm isn't really that much better. Their UX is terrific, but their gaming platform is, you know, basically immaterial. Their ad product is basically immaterial. Yeah, they're locking down passwords. That's their big innovation. They're raising prices. So I don't see them as a major innovation company anymore. And I think that's really going to be a hard thing for them to compete against these big tech Death Stars.
Well, we had a raised hand. Otniel Calderon, do you want to ask a question on the air?
Hey, yes, Evan. I wanted to understand where I didn't see Samsung in any of your quarterly earnings here. So I know that they have a fledgling ad business and their TV business has been growing. Just want to know what you think about them in the media landscape and
Yeah,
how they fit
no,
into this.
yeah, I'm really sorry I didn't. I'm actually looking up their earnings report right now. Yeah, I mean, you know, I think they're, you know, they're a you know, not the most transparent company in the world. You know, so yeah, they've had a rough year. Most notably, you know, there was this kind of thing that happened, you know, during lockdown, where you know, they sold way more television sets than they thought they would. And so year on year, you know, comparisons are a little bit hard for them. So when you look at their yearly trajectory on their market capitalization, I mean, they're up for the year, but they're kind of, you know, not really kind of fluctuating up and down. Although, you know, I do think that I do consider them to be one of the future players in when I talk about big tech really kind of being at the center of everything. I definitely include them. But there's a couple of different things. The way that Sony is really capped by their electronics business, you know, Samsung is really capped by being a family-run business that will, you know, is very conservative by its very nature. That said, you know, their ad sales business is massive. I think they'll do over $1 billion in ad sales this year on Samsung TV Plus. I think they're one of the more successful. In fact, they're the biggest FAST platform on the planet right now. I think they're, you know, the more monthly active users in more territories. I very much also, if anybody's read or seen me speak recently, I think there's a ceiling to FAST. You know, they'll do about $4 billion in ad sales in FAST domestically this year, but globally, you know, in 5 years, FAST will be a $14-15 billion a year business globally in 5 years. YouTube will do $31-32 billion this year. So just YouTube, not Google. So, you know, I think Samsung has a really good ad business. I think best in, you know, one of the best in breeds in FAST. But I also think there's a ceiling for FAST writ large. Washington Post. Yeah, I mean, I don't know much about their new CEO, to be blunt. So it's hard for me to make a lot of projections there. They have been behind the innovation curve when you compare themselves to the New York Times. So I feel like, unless they can really take a lesson out of the New York Times transformation case study, I just think they're a good newspaper, but I don't know what much more than that they are. And, if it wasn't for, the fact that they have a, billionaire owner who likes the news, I don't know what their future is, to be honest with you. In the fast AVOD ecosystem, where does the growth opportunities for global players? The fastest growing territories in FAST are really outside the US. Now, that's relative to the whole. Remember, they're starting in a much lower place. So US will be, 80% of all FAST revenues for the next 5 years at least. But the biggest, fastest growing areas outside of that are the English language territories. So Canada, UK, and Australia, all triple-digit growth in ad sales over the next 4 or 5 years. But Brazil is growing very fast, pardon the pun. Germany is growing very quickly. Now these are nascent businesses. So, it's easy to show a lot of growth from 3rd grade to 2nd grade. But there is a lot of opportunity and there's a lot of demand in Germany, Brazil, Australia is growing like a weed. Italy, Spain, Asia less so. And that's, I think in large part because Asia is a very mobile driven territory where fast doesn't really, have the same type of hold or even promise. I mean, revenues in both Japan and South Korea are there, but they're teeny compared to kind of the size of the populations, and especially given the amount of media consumption that those two territories demonstrate, like, teeny. And once again, like, I think fast is an interesting business. You should definitely be in it. But if you're resting all your eggs in that basket, not so much. You have to have a unified, connected television strategy. If you're investing in fast, you should be co-investing in YouTube. YouTube is the #1 connected television channel on the planet Earth. YouTube is the #1 television channel on the planet Earth. It's the #1 video platform on Earth, mobile and CTV, but it's the #1 television channel in the US. 10% of television usage in the United States right now is YouTube. Bigger than Fox News, bigger than CBS, even when Yellowstone is on. Massive. And when you count all their products together, YouTube Kids, YouTube Premium, YouTube TV, and YouTube Regular, it's even bigger than that. And so to look at a horizontal premium 16, and by the way, YouTube is all in on the 16:9 horizontal connected television business. Yes, they're still in mobile, no question, but their shorts business and their vertical business is seen as kind of, okay, we're going to watch what happens there, but they're putting all their investment in the horizontal 16:9 premium CTV space. And so if you're investing in fast, you should also be looking at a YouTube strategy that treats both of them as spokes off your IP hub. Lean back
question.
Is the lean back CTV approach in developed economies skewing opportunities? Yeah, so no, ignore everything I just said when you talk about Asia and Africa. Africa, which by the way, half the population is under the age of 20 in Africa. 1/3 of the fastest growing economies on the planet Earth are in Africa. And probably some of the most important new business opportunities on the planet will be in Africa over the next decade. And so it's a great opportunity. Nollywood now produces as much film on a yearly basis as Bollywood and Hollywood. And that's just one territory. Look at that entire, and yes, there are regions in Africa that are a little bit less advanced than others, but the population is young and they're earning more as a group year after year after year after year. And so the opportunity is massive there, but it's a mobile first, crucially, not only mobile first, but non-Wi-Fi based mobile first business. So you have to look at it very differently than you would any other territory. And it's almost entirely ad based. Very, very, very little subscription based business there. Do you think the Justice Department will continue to sit on the recliner? Yeah, I mean, Lena Khan's trying to regulate. She's just not very good at it. She's not the Justice Department. But if you look at the case, the Justice Department's case against Google right now, I think there's an excellent chance. I don't think they're gonna really hurt Google's monopoly in search, but I think they're gonna get a big fine out of them. And I think, I think the Justice Department, the FTC, we can, and more importantly, what's happening in Europe. And I think if you're going to look for regulators to make major differences in big tech's monopolistic behaviors, look to Europe. They're just better regulators than the United States. They're tougher. They don't give up very easily. They have patience, and they're just too big to ignore because it's a block of countries except the UK who decided to take their toys and leave. And so, I do think regulators will have an effect. I just don't think I don't think you're going to see companies get broken up. I don't think you're going to see things changed through laws as much as you're going to see lawsuits, and other challenges kind of force companies to re-examine things on their own. Will YouTube CTV drive 4K content? Other analysts claim 4K. Yeah, I mean, the adoption of 4K is just very slow. There's just not enough content to satisfy spending that much more money on a television set. When that happens, and then it goes back to the bottleneck problem. Like if suddenly everybody's pumping out 4K content across the pipes, I'm telling you, the pipes can't handle it. They just can't. And so it will be a shitty experience. You'll have this very expensive television set. You're going to be watching a 4K channel and it's still going to look like crap. And so, the larger problem for 4K is that there's this bottleneck on this side of the head end that is just going to stop, the user experience from being anything other than just really awful. I think I have time for just one more question. Yeah. So the bottleneck is the pipes can carry everything to Comcast's big server centers, right? But they can't, unless and Netflix did this with Comcast, put your server on the other side of it. All this video there's this compression problem as you get, if you've noticed it, I live in an apartment building in New York City. If a lot of people in my building are using the internet at once, everything suffers in my building. That's not a delivery problem. That's the infrastructure problem for the pipes that were dug, I don't know, a long time ago. And it doesn't matter how good the water boiler in your house is or how good the water tower on your roof is. If your shower head is all clogged, shit can't come through it. So that's that time, multiply that times thousands. And it's even worse in Europe. So, yeah, it's great. Asia doesn't have this problem at nearly the same rate that we do. And it's going to be a real major problem. I think do you think it's a good strategy? Yeah. No, we talked about that. I think I got everything right.
Yeah, I think.
Cool. I think, we have to, so who was the first person to both answer the question correctly, which was, I believe, the Pixies. Where is my mind? Even I knew that one, and still be here. Steve, do you have the answer?
It was Matthew LeCount.
There you go. There he is.
One before. So congratulations, Matthew. And as I feel
like it's rigged.
I think we mentioned before, you can win once this week. So just
that's it. That's it, Matt. And this will be up at some point in the future online too.
Yeah. Next week it'll be on youtube.com/streaming media video.
And we've got great panels. Go to our I'll be here all week. I'll be moderating a bunch. I have a panel tomorrow at 10. I'll be hosting all week. Thank you for your applause. And there's going to be great content all week. Great panelists, great execs, great information. Please come back. And thanks for hanging out this whole time. This was there were over 100 some odd people for the entire time. So I really appreciate it. I hope this was valuable. And I hope to see you again soon.
Thanks, Evan.
Bye, everybody.